Stocks are mostly down to end the week over concerns about the health of the global economy. Investors are looking ahead to data on consumer prices out of the U.S. on Friday. Analysts expect inflation for the month of April to have stayed at just over 8%. That's slightly lower than the 40-year high of 8.5% reached in March. And across the Atlantic, investors are digesting news that the European Central Bank will raise interest rates next month. That would be the first such move in more than a decade, with further hikes planned later in the year. The ECB is aiming to tame consumer prices that have put a strain on households.
High inflation is a major challenge for all of us. The Governing Council will make sure that inflation returns to our 2% target over the medium term. In May, inflation again rose significantly, mainly because of surging energy and food prices, including due to the impact of the war.
For more on the story, let's go to Craig Erlam, Senior Market Analyst at OANDA in London. Welcome back to the program, Craig. Now, a big move planned by the ECB, and it's coming a little late compared to the Fed, which has already been raising rates. So is this an indication that maybe they're moving too late and maybe it raises the risk of plunging the European economy into a recession or an economic slump at the very least?
Well, I think that's probably an accusation that's been levied at all central banks around the world so far this year. If you think that the ECB is going to be raising rates from July, the Bank of England started raising rates back in December, and even they are being criticised for moving too slowly and too gradually. And you look at the Federal Reserve, they started raising rates in March, and again, they've been heavily criticised, and they're having to do 50 basis point rate hikes. The problem is that every central bank has been waiting for evidence that inflation has become ingrained. That's through wage growth, this kind of spiral, this negative feedback loop in the inflation data. And the important thing to know here from the ECB's perspective is that they haven't learned from past mistakes. They haven't learned from the Bank of England's mistake. They haven't learned from the Fed's mistake, the Bank of Canada, the RBNZ, the RBA. All these central banks have started raising rates eventually when they've started to see it become more ingrained. But the one thing they all have in common is the inflation data led and the evidence of it becoming ingrained followed in every single case. The ECB thought it was different and it wasn't. So therefore, there's going to be a lot of criticism levied its way because it could have moved sooner and it ultimately should have moved sooner because it should have learned from the lessons of the other central banks and the other economies. Now it's going to have to move faster. 25 basis points in July to get things going. And some would argue they should move faster and go for 50 basis points. But 50 basis points in September looks almost a given at this point, and maybe 2 or 3 more thereafter.
Right, talking about that negative feedback loop, the term that came up this week from the World Bank was stagflation. That's when prices are rising rapidly while economic growth slumps. How big of a challenge is that, and how hard is that going to be to solve?
It's a massive challenge. It's a challenge because many central banks now have that issue. It's why they're having to raise rates so aggressively, because otherwise inflation becomes ingrained, growth will slow to zero, and it's very hard to get out of that cycle. Is very hard for businesses, but it's also very hard for central banks who are then forced to decide, do they want a recession or do they want to get inflation and get inflation under control, or do they want to try and support growth and risk inflation getting out of control? No one wants to be in that situation.
All right, Craig Erlam joining us from London. Thank you for the analysis.